Good morning or good evening to everyone, and welcome to today's Captive Review Virtual Symposium. I'm Lauren Ingram, the editor of Captive Review. So we're running a series of these, and today is our symposium on captivating COVID-19, pandemics, parametric and risk pooling. So welcome. This is obviously a very important topic given the state of the world at the moment. So first, we've just got a little bit of housekeeping. As it's a virtual symposium, which is interactive, you have an opportunity to ask some questions, which we're going to address at the end. We've got, to do this, you need to go to the website slido.com and enter the code CaptiveVirtual when prompted. There will be a Q&A at the end, so make sure you put your questions in. Today we have an excellent panel, which I'm very excited to moderate. We've got Ollie Schofield, who's the head of Captive and ART Consulting at Principal Re. We've got Farah Jaafar-Crossby, who's the CEO of Labuan IBFC. And we've got George McGhie, who's the Managing Director of Asia Pacific Captive Practice at Willis Towers Watson. So I'm very excited to have them all here today. So let's start what will be a very exciting panel. So Farah, if I want to ask you to start off with an opening statement on COVID-19 and captives.
Thanks, Lauren, and thanks, Ollie and George, for being on this. And I'm really excited about being able to, address this issue. I think COVID-19 has been unprecedented. Is a word that's obviously been abused when it comes to COVID, but really there is a limited vocabulary in the English language considering the scale of what we're looking at. It is unprecedented, and I think it's going to require a solution that is outside the box. And so Captive may have a part to play here, but personally, what I think is it's going to be a solution that's going to need a lot of different bits, a lot of different moving parts. I think Captives is going to be a key portion of that. But also I think it's going to require a lot of political will. So it's going to be interesting to see how we move forward with self-insurance and how the role of insurance evolves as the need for risk management heightens because of COVID and situations, as we will see as the year goes by, with natural cat losses and stuff like that.
Thank you so much. Ollie, if you want to continue.
Yes, thank you. And Farah, thank you very much for inviting me to be part of this event as well. Good morning, good afternoon, good evening to everybody. This obviously is an absolutely devastating event in so many ways. And our thoughts are with everyone who've lost loved ones or have been impacted in any other way. Captives have always had a role to play in the world of insurance, especially in times of catastrophic loss and subsequent economic downturn. And I think we cast our minds back, whether it be post 9/11, post Katrina, Rita, Wilma, or even going back further to the 1980s global liability insurance crisis. Captives have always shown their resilience and have stepped up to bring cover and pricing stability and coverage innovation to their parents. And I passionately believe this time will be another great opportunity for Captives to demonstrate their lasting value to the industry as a whole. I think we should keep in mind that this will be the single largest insured loss event in history. There will be immense pressures on all of us in the insurance and reinsurance industry, regardless of what sector we represent, whether that's financially, whether that's reputationally, and whether that's socially. And I think collectively as a group, we have to stand tall, we have to stand together, work together, and find creative solutions for businesses going forward.
Thank you so much. And George, if you want to finish us off.
Certainly, yes. I think, as Farah said, I mean, obviously the current situation is unprecedented, and in the face of an uncertain future, new thinking is needed. There's long been a tendency in the insurance industry to think of risk in terms of insurance product classes. And even now, much of the debate about the impact of COVID is in terms of BI insurance or liability or D&O. But surely the key issue is the overall impact of events like this on the financial resilience of people, of organizations, as well as of countries and regions. It's not really about how to secure insurance through conventional product classes, but how to structure a risk financing strategy which is reactive to the needs of the individual, whether that's a person, a family, a company, or of a society, a population. And that strategy has to be flexible enough to adapt to changing needs. Very often we react to an event with measures specifically focused on that particular event. And I think the key lesson from COVID in this regard is that anything can happen. We need to try and prepare for any eventuality. We need to be able to maximize the leverage of internal resources in situations where reliance on external resources, external funding, whether that's insurance or other forms of funding, may not perform the way that you would have liked. And again, those messages apply to companies as well as to governments. We know that the insurance market was becoming more difficult even before COVID. It was no longer a cheap cover for every type and level of risk. And we can expect the market to get even harder, and at a time when the economy, the world economy, is contracting. So companies need a methodology to clearly define risk tolerance, risk appetite, and a capacity to fund losses, and to reevaluate their whole approach to risk finance. And their strategy must deliver financial resilience. Now, insurance will still play a vital role, but in buying insurance, you have to look at it as one of a number of mechanisms that you can use to finance your risk. In that environment, captive techniques will be more important than ever. And as Ollie said, they have been in history. They've proven themselves in a number of circumstances where insurance, conventional insurance, has become difficult to acquire, whether because of issues within the industry or because of broader issues such as huge catastrophe losses. So captives provide flexibility. They allow you to adapt your risk financing program to take best account of your ability to finance your own risk, as well as the products that are available from the insurance market, which change over time and change in pricing over time. They also allow you to access the broader world of insurance capacity through reinsurance, possibly through insurance-linked securitization, which Farah will tell us all about, because it's quite a technical area for me. But it's also possible to look at spreading risk through sharing risk with others who've got the same type of exposure. And we see this a lot with industries. There are a number of captives that have been set up within industries to help manage exposure. But it can also work at a society level, at a country or a region level. We've seen that with the pools in Pool Re in the UK, set up for terrorism risks, TRIA in the States for the same, and the World Bank has sponsored a number of insurance companies that are focused on covering natural catastrophe risk, Seadrift in Singapore, PICRIC for the Pacific Islands, CRIF for the Caribbean. And those pools and NatCat insurers are examples of captive techniques applied on a greater scale. COVID is an example of a risk which requires funding at societal level. It requires.
I think we've lost George, so we're just gonna, I think we'll just start with the questions.
Yeah.
So Just a reminder to everyone as well that you can go onto Slido and ask any questions at the end and use the hashtag #CaptiveVirtual to make sure that you get it to us. So I guess if we start with you, Ollie, for this, how can captives play a part with pandemic insurance following something like COVID-19? What can captives do in a situation like this when people are looking at pandemic insurance as an option?
So I think in the context of where we are in the market, captives can play a very significant role going forward. The pressure that is going to come from the market, I see, is in 4 different areas, which some commentators are beginning to refer to as being the 4 horsemen of the apocalypse. The first one is the pressure that is going to be brought upon organisations to take increased retentions at the corporate level, and therefore into the captive. The second area is going to be in the increased premiums that insurers and reinsurers are understandably going to be demanding for coverage in general. George mentioned the fact we've been in a hard market now for some time, and certainly with this event, the largest loss that we've ever faced in history, you can only expect premiums to continue to come under pressure. I think the third area that we're going to see pressure is in the wordings. Now, some of that will be welcomed because it'll be clarifying the intent of coverage. And there are lots of discussions going on at the moment about whether or not losses should be covered or are covered. So clarity in wordings is important. However, it'll also be used as the opportunity to reduce and restrict cover. The fourth area is in terms of pure monetary capacity that is available in the marketplace. We have already seen in certain segments of the market a rather large withdrawal in terms of capacity that is available. Only 2 weeks ago, an organisation in the UK published a report that showed 30 different insurers had pulled out of the corporate and personal travel insurance space. That's a significant reduction in capacity. So if you look at those 4 areas, retentions, premiums, wordings, and capacity, these are areas where captives can absolutely support their parent organisation. Those organisations that already have captives are, of course, well placed to absorb and mitigate against these changes. And captives can look to increase their gross retentions. They can look to increase the coverage that they offer to their parents. However, those organisations that don't have captives should perhaps now start considering whether or not it is worth their while establishing captive vehicles so that they can then manage the instability that we are going to see in the marketplace accordingly. I can go into more detail on that a little bit later. But I think it's also worth considering with the captive what the actual size of this loss means to their parent company, and therefore their ability and their appetite to retain risk. Because it's all very well sitting here and saying, yeah, you should increase your retentions, you should offer broader cover. But obviously that has to be within the restrictions of the affordability of those increased retentions and the risk appetite that organisations have. And I think it's perhaps time that organisations considered that they might have a better risk appetite than perhaps they originally thought. In the event that we have this situation go a second time, another massive pandemic or another loss that impacts the world in such a way, if they haven't built up the retentions within or the financial muscle within their captive, then they're still going to be in the same positions they are now. So a relook at the appetite and their ability to retain risk.
And Farah, what are your thoughts on this?
So I'm going to be a little bit controversial. So someone said to me the other day, look, this whole captive thing is great, but isn't an issue of pandemic kind of like created a situation where it's almost too little too late if you haven't got one already, number one, because we really don't understand what the landscape is going to be like moving forward and how expensive it's going to be to try and get some cover, right? and I'm not captured. Obviously, the disclaimer is going to come out. I'm not an expert like George or Oliver. And yes, it is going to be difficult, but I think the idea of having a captive when you think you're going to need one is a little bit delayed already. So a lot of it has got to do with thinking forward, regardless of how unattainable you might think it is at the moment. I think that is one of the things that you need to start considering as a business owner. And I think the time is probably right to start looking at mutuals, where you are looking at a risk that is shared or that can be netted off, but you are able to then more afford one, and also be able to understand that you have some cover. So pure captives, the way maybe we understand it to work, is fine and great. But moving forward, maybe it's a situation where you need more mutuals, you need more association captives, you need captives that are quite focused in the area that they're looking to cover the risk or the geography. So this is, I think, how we start to look at the captive solution evolve in a way.
Yeah, that's really interesting. And George, do you have any thoughts on this?
Yes, I mean, we, as I say, with the market having been in a difficult condition for at least 18 months, certainly in the case of the Australian market, and certainly for certain lines of insurance, we'd already seen a major increase in captive and captive-related activity over that period. So there was already a focus into captives, and clients were beginning to think more about risk rather than about insurance. So rather than just thinking in terms of buying the insurance that's available, there's thinking about the nature of risk that they face, of whatever type of risk, and being able to value that, being able to, a risk manager or a chief risk officer being able to report to the board on the areas of risk faced by the company and the valuation of that risk. Now, we've always known that there are mega risks that everybody faces, the black swan events, I think they're called, where you really can't adequately finance for them and keep your operation running. It's about managing your operation to get the best return from the resources you apply. But it's still important to know and understand what those exposures are and to have a response plan that's not just about getting money in, it's about how you manage the impact on your business. And we're seeing COVID in sort of 3 stages. The first stage that we're all in right now is responding to the crisis, is understanding what it means to our employees. Key responsibility of any employer is to his workforce, to clients, suppliers, and what their problems mean to your business, and surviving. Ensuring sufficient cash flow to meet your obligations to be able to survive through the crisis point until you can begin to emerge from it. And then it's about managing moving forward from there. Now, as Farah said, if you have a captive and it's got hundreds of millions of dollars of surplus, that gives you some capacity to be able to help with the cash flow issues the business faces. If you don't, then taking cash out of the business to invest in a captive is probably not a very viable solution when cash is your big problem. But once you begin to emerge from the crisis and look forward, I think, it's often said that there'll be a new normal in the way we all live, in the way the world operates. And that'll be true of risk and insurance as much as anywhere else. Part of that new normal will be analysing your exposures to risk to really understand where you need to be focusing your resources, where you really need insurance. Ollie said earlier, many companies are buying insurance in areas they don't really need it. They're buying way down at very low deductible levels. You really need to focus your insurance spend on protecting against big events that threaten your future. And I do think that's going to become much more of a focus with clients. once you start retaining major risk and looking to access different markets to help you finance risk, captive becomes important as a mechanism to centralize and control your risk.
Yes, completely. And so what is the role of financial inclusion in the times of a pandemic? Farah, do you want to start?
Yeah, I mean, I think, as I said, the response to a situation like this cannot be a box standard response. And I just want to chime in with George, to George's earlier comment. So as a jurisdiction, what has happened is that we've seen, as the market's gotten harder last year, and progressively, there's more interest in protected cell companies, where you're allowed to net off a lot of that risk and where you're able to manage that risk as well. And I think a situation like that would be quite interesting going forward. When you look at financial inclusion, really, it's about the severity of a pandemic. It's about the need for a social safety net, and how a captive, together with a digital solution that will allow for cheaper access, cheaper management via fintech, via insurtech, then allows for financial inclusion to be able to come to the fore. So I think, if you remember what I said in the beginning, there are a lot, it's a pandemic, yes, it's an illness, yes. But like everything else, it comes with layers of complexity. And I think COVID is a classic example of that, where you look at a situation, and it's a health crisis that's very quickly become economic crisis, that is now a psychological crisis, that is a socio-economic crisis. It's now a global situation with layers upon layers. And I think at the end of the day, financial inclusion is an area that we need to ensure kicks in, whether it be via captives, pooling, multinational, multilateral initiatives, in order to really create a situation where everyone is covered and that we can move forward collectively in a safer environment. So I think if you look at financial inclusion as the ultimate objective, you look at captive as one of the ways to get there. You look at digital alternative finance as a way to facilitate captives. Then what will happen is that you've got all these moving parts working cohesively to try and create a solution.
And George, do you have any thoughts on this?
Yes, I mean, I couldn't agree more. We've been having conversations with governments, with multilateral development agencies such as the World Bank and the Asia Development Bank. We know that the World Bank, for example, is mobilizing, I think, $14 billion of funding to support the recovery from COVID. And that's coming from a wide variety of different mechanisms. As I say, in the area of natural catastrophe risk, their approach has been, again, a wide variety, but including the establishment of insurance companies, which are captives, as we would know them, to fulfill all the roles that a captive generally does in centralizing the risk, acting as a controlled tool to engage with the clients, the countries in this case, and to access the reinsurance markets and capital markets in support. So it's captive techniques being applied to the societal risk and to ensure the inclusion of all members of society in the solution. But it's not simple stuff, because it cuts across a whole range of issues, political as well as economic, as well as practical. So it's not a quick fix, and I'm not sure that the insurance element of that 14 billion that we talked about for World Bank is a hugely significant portion of that. I think the aim going forward is to engage more in a public-private partnership approach to build that element.
And Ollie, what are your thoughts?
Yes, I certainly agree with both what George and Farah have said there. I think it is incumbent upon government to work with industry to provide solutions for the unprecedented, unimagined losses that happen. And we saw very quickly how certain governments around the world announced emergency packages for financially for organisations, be it here in the UK, in the US, or elsewhere. But I think also we need to consider the impact that this event is going to have on those individuals who don't have the same protection net that we might have in other countries. And if you look at some of the reports that are coming out of some parts of the world where people simply haven't had the wherewithal to purchase insurance, don't have regular jobs, don't have a regular form of income, these are the ones who are absolutely falling outside of safety nets that are being put in place by well-intended safety nets that are being put in place by governments around the world. So whether it's the World Bank, World Food Programme, other parts of the United Nations stepping in and providing community-driven protections, be it for crop insurance, for other forms of farming exposures, or indeed some of the well-known examples that George mentioned in the way of sea drift and so on. These are so fundamentally important if we are, as an industry and as a world, going to take front and center responsibility for the social aspect of massive losses such as these.
And there has been some talk of government introducing federally backed pandemic insurance programs. So what are your thoughts on that, George?
Well, that has been the response to these types of mega exposure in the past, with Pool Re, as I mentioned earlier, for terrorism in the UK. Nuclear exposures are held at government level, so that there are many exposures which are managed at that level. And I think in the case of COVID, infectious disease exposures, I mean, we can see that many insurance policies deliberately include an element of coverage against infectious disease. Many more either excluded it or attempted to exclude it and have now got uncertainty because the wording wasn't very clear. So it's been in a grey area and probably not as well defined and managed as it should have been in understanding where responsibility lies for funding the impact. The reason for that is probably because I won't say nobody, lots of people, lots of experts are putting their hands up now saying, and with evidence that they'd warned about exactly this, and you know, it should have been known and understood and managed. I won't put my hand up for that. It's not something that everything we're dealing with in our daily lives right now, I had no clue was going to come about. So responding to that going forward, I don't see any other way to try and manage it other than for governments and intergovernmental agencies to take a lead in that. And initiatives such as the one led by Stephen Catlin in London or in the UK to pull together the insurance industry to begin discussing with the government and I believe the development agencies how to structure that, how to pull it together. Those initiatives need to be replicated worldwide.
And Farah?
Well, yeah, I mean, it's something that is, I know it's kind of dystopian in a way, but you need this partnership between governments, between multilateral organizations, between private organizations, failing which, you have a situation where literally where we were confronted like a couple of weeks ago, it's just helicopter money dropping down, everyone's giving away helicopter money. It's not a situation where a trigger kicks in via mechanism and coverage is given. And I think it is simple for us to sit here and say, oh, right, now, you're talking about this. But I think, if we are unable to look forward and think, if there isn't a situation like this that will create a solution for later, then we're kidding ourselves, because this is not the first and the last time we're going to be presented with a situation like this. And I think it's also important for us to understand that, you know, as much as markets are going through, you know, in 2008, everyone was looking at the derivatives markets and they were saying, oh, it's the CD, the collateralized debt instruments creating this meltdown, da, 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 da. And today we're saying, oh yeah, it's the insurance guys not kicking in, not picking up the slack, as it were, you know, not honoring the clauses, you know, and the government's coming in and saying, I'm sorry, contract law, what? No, you're just going to have to deal with this. You're just going to have to pay up. It's ultra-virus. You know, you're going to have a situation when people start arguing about whether there is a payout or not. And as I said earlier, it's not that simple. It cannot be a situation where it's just left to the insurance industry, the risk management industry, or government. It also has to be a situation where that risk needs to be then portioned out within the securities environment, where you have ILS, where you have then primary issues, where you have ILS and traded. I mean, overnight, ECB said that they'll start accepting junk bonds, right? And then you have a situation where the IMF is looking at a perpetual bond, where governments are then now allowed to issue perpetual bonds that they did during the plague, and allow just, you know, not premiums to be paid, but just the coupon rates, which could be very, very low. So it's not just about insurance, is I guess what I'm trying to say. It's about a coming together. And maybe I'm quite dystopian in my view, but I think there has to be a reason for this COVID. And if COVID's the reason we all come together and look at the bigger piece, then let's do that.
Yeah, I guess like you said, it's not just about the insurance industry. And there's a lot going on, and I guess a lot of pressure is being put on the insurance industry, and a lot of media is looking at the insurance industry as this is your responsibility. But this is a global pandemic and there's a lot going on, and a lot of people have to come together to kind of solve this problem, rather than just in the insurance industry right now. So yeah, Ollie, do you have any thoughts on this?
Yes, thank you. I think from an insurance perspective, we all need to be very, very clear that, as always in our insurance world, policies will respond and will pay for this event where coverage has been purchased and paid for. Personally, I feel it is completely wrong for governments anywhere in the world to step in and demand that insurance policies pay where there is a clear exclusion in the policy, or there has been a clear decision by the buyer not to pay the additional premium to purchase the exposure. That is not the role of the insurance industry. Our role is to pay valid claims swiftly, without any kind of confusion or deliberation. But having said that, I recognise there is a role and there is a need for government to step in as insurers of last resort, as a significant number of businesses right now around the world are facing ruin. Some would say, well, why should governments protect businesses? Because after all, their businesses succeed and businesses fail. If they haven't planned properly, why should they get a government bailout? And I think the answer to that goes into very much what Farah and the Labuan IBFC have been championing now for some time, which is the massive social impact. If these businesses are allowed to fail, then there will be a significant number of people who no longer have the livelihood to enable them to survive. We're talking about basic human survival in many parts of the world. So yes, government has a role. And as taxpayers, be it corporate taxpayers or personal taxpayers, we all have that responsibility to pay our taxes, to ensure that governments have the wherewithal, and World Bank has the wherewithal to be able to step in and provide support. Now, I look at this in two ways. There's the immediate need and the ongoing role. The immediate need is to bring economic stability to countries around the world. That is being promoted already by certain countries. The second, and perhaps in my view more important, is bringing social stability. We have not yet seen some of the mass social breakdowns that we saw after certain events around the world. I mean, I'm thinking back to the days of the Los Angeles riots, which went on for several days, the London riots that happened all those years ago. That is a breakdown in social order that we have not yet seen, and that's wonderful. It's very gratifying. And thirdly, financial relief measures need to be brought in, designed to stop that economic and social order collapse due to people having to spend significant amount of time in lockdown under various movement restriction orders. From an ongoing perspective, clearly the insurance market will never be capitalized to a level where it can provide cover for absolutely everything on an unrestricted, non-aggregated way. So as the insurance market can't provide suitable economically attractive cover going forward for absolutely everything, then government in conjunction with the insurance industry experts should be looking to provide these solutions at the appropriate cost. Now, to me, that is essential for those businesses that are particularly too small for the captive or the risk pooling route. And I'd like to perhaps go back to the risk pooling route a little bit later on to talk about how that's working. But anyway, current examples that are already being announced and being considered include the Stephen Catlin-led initiative that George mentioned, PanRe, certain insurance leaders in the US, Greenberg amongst them, Chubb, is talking about PRIA, so the pandemic version of TRIA in the USA. Now, this is obviously it's a very well-trodden path, and vehicles already exist everywhere. So it shouldn't be beyond the wit of all of us to be able to promote and drive these vehicles and do it now for when the next big event will happen, because there are concerns that COVID-19 will resurface. We saw some of the restrictions being relaxed in Germany last week, I think it was, earlier this week, and already they're beginning to see a massive increase again, or uptick in the number of people who are infected and who are dying. So we need to get something in place fast, and that will provide a combination of social and financial protection for this existing event as well as future events.
Yes, completely. Now, I think that, obviously COVID-19 has had a massive impact on the world, which obviously means a massive impact on the insurance industry, and I think on many industries. So what are the main lessons that we can learn from COVID-19 for risk managers in particular, if we look at that? Farah, if you want to start.
How do you begin to manage a risk that is completely unfathomable at a speed that is beyond understanding? So it's a very challenging environment that we expect risk managers or governments to kind of pick up. And I think, we have to be fair to everyone. Risk managers, insurance, governments, it is difficult. And I think one of the key things, not just risk managers have to do, and I think everyone, all of us included, is that we have to start working together towards creating a solution. I think if we sit in our silos trying to figure out how are we going to produce a solution, we're kidding ourselves first. When it comes to risk management, I think that conversation about, yes, we didn't consider this, but what are we going to do moving forward? How are we going to do it? I think that that's an important element. As risk managers, it's always important to consider a known unknown, is it? It's, if there is such a thing, or is it known unknown or unknown unknown? I can't remember what Rumsfeld said all those years ago now. But it's a tough one. And that's putting it mildly. Sorry if I haven't answered your question, but I don't see how I can, to be honest.
No, that's great. Ollie, do you have any thoughts?
Yeah, thanks, Love. From a risk manager's perspective, I would, if I were a risk manager, I would be looking to my brokers, my advisors, and my insurers to see what options there might be for me to be able to build up the necessary protection that I need So I'd look at two different areas. The first one would be parametrics. Now, there were already a few parametric pandemic deals that had been structured before this event, because there were some organizations that recognized that any kind of impact like this, or even to a small degree like this, would have a devastating knock-on impact to their business. So there are some pandemic deals already out there on the parametric basis, and we'll just have to wait and see how that transpires from the point of view of whether they're going to be triggered. I'm not familiar with the specific trigger indices that exist in those deals, so I can't comment on that. But obviously we'll wait and see. There is already a certain amount of activity in the parametric space for new products, as we all work collaboratively to build solutions for the future pandemics. Now, these are tailored to pools of business, be they be broker-driven pools of business, or even business driven by mutualization of risk. It's important to recognize that these will not be cheap solutions, but they will be a valuable solution as the current pandemic parametric covers are proving. And that brings me on to the concept of risk pooling. Then this is a successful, well-trodden path used by corporate buyers in various occasions in the past when cover is either no longer available, is economically attractive on a first loss basis, or only available with significant retentions and coverage restrictions. So it's going to be a blend of various different types of structure. You can have a captive structure, you can then have in the next layer a mutualized or pooling structure, and then you can have higher up in the program the parametric pandemic or parametric catastrophic cover. And that therefore brings to the risk manager a solution that becomes much more cost attractive and coverage broad. And we have examples from the past, most notably in the 1980s, when the oil industry set up OIL and OCIL, the rail sector set up track and rail in North America, and of course ACE and Excel, two very well-known insurance companies today, they were set up by Marsh back in the 1980s to provide excess or casualty cover to their North American buyers because the casualty market had vanished almost overnight. So there is precedence for this. They are successful, they work well, and they provide the risk manager with options as to how they can actually buy the best coverage at a price that becomes economically attractive to their own organizations. The challenge always with these vehicles is when you ask companies from the same industry group to start sharing information about their risk, their expenses, their exposure, because they don't like sharing that information. But I think needs must, and they must put aside some of the reservations about information being shared and revisit these well-proven approaches.
Yes, yeah, I think that's really important because like you say that there are reservations, but in a situation like this, like sharing that information is really important and will benefit everyone. So that's a very good point. George, do you have anything to add?
Sorry, I was frozen for a moment there. Is that a question aimed at me?
Yes, yeah. If you have anything to add.
Okay. I caught most of what Ollie and Farah said, and agree with everything that's said. I think what really comes out of this, and not wanting to be repetitive, but it really is about.
Oh, I think we've lost George again. All right. Well, we do have quite a lot of questions that have come through.
Everybody involved in risk understanding the whole potential.
George is cutting out. So I think as I said, we've got quite a lot of questions that have come through. So Farah, Ollie, George, does anyone have any final comments before we go to questions? Farah, anything else you want to add before we go to the questions? No.
No.
No, I look forward to addressing some of the questions. I mean, I think the key thing is that we all need to keep in mind this is not only about the insurance industry's financial response. It's also about government response, financial markets response, general business response, society response to ensure that we can all come out of this and come through the other side in the best possible shape.
Yeah. So this is, if we go to Slido, so just to remember, if you go to slido.com, if you've got any questions and enter the hashtag captive virtual, you'll be able to put in your questions. So we've got quite a few here, and people can also like the questions if they think it's a good question, so you can see some of them here. So we've got one of the top questions here is, can we get a more precise on how specific pandemic reinsurance can look like? So I'll go to Ollie if you want to have any questions on any more information on that.
Yeah, are they asking from a structural point of view what a reinsurance structure might look like, or are they asking from coverage? I'm not quite sure I totally get.
I'm not sure. I'm guessing, yeah, if you anything you want to go on. Okay.
Well, look, the reinsurance industry, of course, is underpins the operation of the global insurance sector. The reinsurers are often able to put together programs that are potentially broader than the direct insurance industry, as certain reinsurers are the reinsurers of last resort. They are the ultimate risk takers that don't purchase their own reinsurance. Therefore, they decide, based on their knowledge, their vast breadth of experience, as to what cover they feel they can offer in certain circumstances. And they're the ones that also often are the ones that are behind the driving of new creative solutions such as parametrics or multi-class portfolio protections. If I were looking at putting together a pandemic solution for a captive on a reinsurance basis, I would look at it on a portfolio multi-class basis. I'd also look at it on a multi-year basis. It's all very well us defining things as business interruption or property or liability, casualty or travel, or contingency, etc. However, when you're in the captive environment, all you're interested in is the fact that you have risk and how you're going to protect yourself against that risk. And one of the most efficient ways of doing that, and this is why insurance companies do it themselves, is to purchase portfolio protection or treaty protection, whether that's on a country-by-country basis, whether it's on a global basis, whatever, it doesn't matter. But buying that portfolio protection as the captive, you can then try to eliminate any gaps in cover between whether this should be a contingency loss or a cancellation loss or BI loss. Those discussions go away because it's overt, it's written in the reinsurance policy that it covers pandemic, full stop, across the portfolio of all of the operations. I think we need to start getting captives to think about portfolio purchasing. I've been banging that drum for years, and it's often fallen on deaf ears. And it's not because it's too expensive, but I think it's quite a complicated way, and many traditional insurers don't like the idea of portfolio underwriting. They prefer to keep it as individual lines.
Yeah, and we've got another question that's similar to this, are you seeing an increase in request and supply by reinsurers for pandemic coverage? What kind of treaty transaction requirement for epidemics definition? So I don't know if George, you want to comment on this as well as the previous question.
Certainly, yeah. I mean, I certainly agree with Ollie in terms of the approach that needs to be taken. It's always difficult to insure a burning house. The market are not falling over themselves right now to invite in pandemic risks. Their main concern at the moment, I think, is the pandemic risks that they are being asked to assume that they may not have intended to, either because their wordings are not as precise as they should be, or because of political pressures and the good old reaction that we see often, that those insurance companies are trying to get out of paying their claims again, even if it's areas of risk that they never intended to cover and didn't receive premium for. But anyway, hopefully sanity will return in that respect. I think less an issue of looking for pandemic cover. It's important, of course, going forward. We'd love to have it, but as I say, it's that burning house. More an issue of defining the level of financial support that your organisation will need if an unforeseen event occurs, or even a foreseen event occurs, a major event occurs, a black swan event. And looking at it on a cross-risk basis, as Ollie said, and looking to be as clear as possible with the insurer or reinsurer as to the terms on which you expect them to step forward and pay. And so it's incumbent on the insurance and reinsurance industry to provide that clarity as well. So when we look at parametrics, for example, I still hear lots and lots of presentations of parametric as being binary. If an incident happens, if these conditions are met, you get paid instantly, no question, no issue. It took an awful long time for the World Bank pandemic bond to pay out, and that was on a parametric basis, and it's not fully paid out yet. That was a specific pandemic bond supported by reinsurance on a parametric basis. It seems a little strange that COVID didn't instantly trigger it, but it took a long time to trigger even the junior level. So being clear about expectations, and of course, the more triggerable you want your cover, the more you're going to pay. That's the risk-reward equation the insurers are working with. So when you're looking for cover, I think it would be naive to think that we could go and buy a pandemic insurance policy soon that provides the same sort of premium to limit ratio that you get on your conventional property or liability insurances. So we have to look for more innovative solutions. We have to look at alternative ways to do things, and we have to look for support governments and development agencies, I believe.
Yeah, so I think that's, again, very, very good points, and I think that'll be very helpful for a lot of people. So we've got a question here for the panel. How feasible is a risk financing pool for COVID-19 along the lines of, pool re, TRIA, etc.? So Farah, do you have any thoughts on this?
Unfortunately, I'm not a risk manager, and unfortunately, I'm not an insurance expert, so I'm really handicapped here. But I would assume that unless there is some kind of backstop, there will still be a profit element that kicks. And and I hate sounding like this lady who represents a jurisdiction, and she sounds like a socialist. But really, you are still going to be faced with the hard truth of profitability. You are still going, as an insurance company, reinsurance company, but at the same time, there has to be a balance. And I think this is where, it needs that partnership. This, going back to the earlier concept of it cannot just be a solution from an insurance point of view. It has to be a balanced solution. So whether it's feasible, yes, I'd hate to think that, insurance is not able to step up to the challenge of, something like a COVID. There's a reason we have insurance. And insurance will continue post-COVID, let's get that clear. But I think there will be situations where it's almost an existential crisis where you're looking at it and saying, okay, this is what's required above and beyond. So I'm sorry if I, again, have not got an answer, but I think it will be feasible once you get a balance.
George?
Yes, as I say, it is there are precedents for events that are that overwhelm the insurance industry. There are no precedents I can think of that overwhelm the economies of the world and the healthcare systems and populations of the world. So we are in unprecedented territory in terms of scale and in terms of sort of human tragedy. In terms of the nature, though, of the response that the insurance industry needs to provide, there is precedent. Conventional cover wasn't designed to cover this type of event. Conventional private insurance wasn't designed for this. It wasn't anticipated by the market. Going forward, they don't have the capacity. The insurance industry doesn't have the wherewithal to offer a blanket cover for pandemic. So it has to be a partnership approach. But there are public-private partnership structures out there in operation in all sorts of, in all industries, in all sorts of ways. And the sophistication of those has developed over time and has been supported by many of the cross-nation political alignments, such as ASEAN with Seadrift. And I think I won't stray into politics, but you know, the value, the virtue of those organisations should be emphasised by what we're seeing here. And it's going to take time to develop that. As I say, we're still in the process of dealing with the crisis. The next stage is moving through to recovery stage, and then it's the new world that we're going to operate in. We don't quite know how that looks. So there will be a solution. It will involve the insurance industry. It will involve our little area of captives. It will involve regulators and government bodies and domicile, captive domicile development people like Farah. It will involve reinsurers like Ollie, and hopefully it will involve old insurance people like me. But it's going to take time to build.
Yes, definitely. And I mean, I think it's exactly what, you know, was said before. You know, it's difficult to insure a burning house, and we're in the middle of it right now. And I think there will be a lot of work that's done after as well, and that will be, you know, a lot. So we've got a question here. Was there any captive now that has addressed COVID-19? I'm assuming is there any captive that had, you know, pandemic insurance or insurance that previously that was able to insure against COVID-19? I know personally I have heard of some captives that had insurance that was triggered by COVID-19 in terms of, you know, policies, whether that was business interruption or pandemic policies that was able to cover them. I'm sure the others on the panel have heard of the same. Ollie, do you, I'm sure that you've heard of some as well?
Yes, very much so. An exercise was undertaken a few years ago when organisations try to consider what the worst possible case scenario would be for their business. And as a result of that, certain businesses actually overtly went out and purchased cover that had a specific pandemic extension to the program. Now, some of those organisations drove that through their captive. Some of them just bought it direct from the insurance market. And I suppose the most noteworthy, or sorry, the most well-known example of that that's been reported in the press all over the world is the policy that Wimbledon tennis took out via Marsh for the exposure that they would face from a cancellation as a result of a pandemic. So yes, the cover does exist, or did exist rather, and yes, organisations overtly went out and purchased it. And indeed, some of those would have run that through their captive and sought reinsurance accordingly. Other organisations will have built up their own funds on their own balance sheet in their captive to provide for these type of black swan events. And I'm aware of several captives that specifically had all risks policies that would cover a multitude of different events so that they could just continue to operate their business. And particularly if you think of the hospitality space where, you know, the bottom's just fallen out of their industry completely. And whether it's just providing the ability to continue to pay wages, whether it's the ability to continue to pay the rent when they've had no income. If the policy is structured in such a way there's a very broad all risk coverage, obviously as the captive you can write your own coverage. You can decide exactly what's in and what's out. And so certain captives have benefited from being able to build a financial strength to be able to cover this particular loss.
It's a good example, if I can jump in on that one.
Yeah, of course.
across our client base, I have a philosophical hatred of dividending profit back to parent from captive, because to me, that's the profit of a captive. It usually is money that's been released from the insurance spend. So it's money that's been saved that you would otherwise have spent. So that the parent company doesn't deserve that. That belongs to the risk and insurance sector of the client. And then it's our job as the captive manager and consultant and our broking colleagues and consultants to work out how to make best use of that money, how to leverage that money to protect the parent organization against risk, not just property insurance or liability insurance, but risk. And pandemic would be part of that. So clients who built up, some of our clients have built up significant capacity within the captive. The event has occurred. Some of them have used that surplus to support cross-class insurances that are there to cover any eventuality, whether pandemic or whatever. That's of value to the parent organisation, far more value than if they drip dividends out of the captive year on year down the years. So I think it's a good lesson about build your asset within your captive, but you have to work that asset. You have to find uses for it. And the prime use is to insure yourself against risks that are not easily transferred into the insurance market.
And that very much covers the next question about loans or dividends to parents versus future balance sheet strength to allow a captive to provide capacity in the future. I mean, Ollie, do you have any thoughts on this?
Yes, thank you. I saw Nick Wild's question there, and it's a very, very good question, very pertinent question. And what George has just said, addressing that, is something that I also totally agree with. Loans are one thing, so long as, of course, they are loans that are made in a fashion that is acceptable to the regulator in the particular jurisdiction that the captive is located in. But the dividend payments, certainly, and I'm sure this is the same for George and his organisation, when we are working with an organisation to set up a captive, our recommendation is always don't think about trying to dividend anything back within the first 5 years of the captive's life. Use any profits to build funds to pay for future losses that as you go into year 2, 3, 4, 5 of the captive's life, you might actually expand the captive breadth of underwriting to cover some of these unforeseen, unknown events under some form of very broad all risks cover. If you start dividending that money back after year 1, then what purpose does the captive actually serve in longer term risk management planning? All it becomes is, let's make a quick profit, get that back into the parent company, and then the focus on risk management and profit sentimentality within the captive just goes out the window. So definitely loans for me versus dividends.
And Farah, do you have any thoughts on this?
Well, yes, because actually it goes back to the core of why you have a captive. And a lot of people seem to think that it's a tax play, right? So what happens is you've got captive, you've got profits, you divvy up, make the money, low tax environment. No, it's a risk management vehicle, which requires active management. And when you start divvying everything up, you're going to be left with a shell. So why bother? When you start having something that isn't strong enough to help you when you need it, like in the time of a pandemic, then you've got to call into question why you had it in the first place. And a captive is not a tax play. Time and time again, it's not. And if anything, COVID is going to hopefully drive this message across, is this: it's not a tax play, because there's no point in having one when you haven't got a solid base when you need it, right?
Unfortunately, we've run out of time, so that's going to be the last question. But thank you, everyone, for coming on today. It's been a fantastic panel, and we've had far too many questions that we've been able to not get to so many of them. So thank you so much, everyone, for tuning in today.